If you've been around for the last 30 minutes or so of the program, you heard from Michael Famaroti before we went on break discussing what really is the nature of FX reserves used in the Nigerian context and trying to provide some answers. Whether this was a sign of growth and what does it really mean with an FX that is induced by high oil prices and portfolio inflows of foreign monies. Michael Famaroti, the chief economist at Vertival Capital Management, one of the licensed investment and securities trading firm on Broad Street. Michael, thank you. Let's continue that conversation along the corridor of we have an FX reserves that looks good, covers some good month of imports, that is induced by the market, but the economy needs its own FX. So how quick do you think we should turn things around to support what the central bank, the monetary authorities already getting done on one hand? Before we get into the next booby trap, then we'll go back to the 2014-2015 story about, oh, sorry, we finished the FX, we don't know what happened, oil prices is down, and becomes a recurring decimal.
Yeah, so I think this is one area that the federal government understands the theory and has a plan on paper to address. So the issue, like I mentioned, is your FX is a hugely important part of the economy. I think someone in 2016 referred to it as the blood of Nigeria's economic body. And that's really very descriptive, right? But the issue is that that blood is coming from a really small part, right? It should be coming from the heart. And what the government sees and seems to be trying to do is try to actually drive FX from the heart of the economy. And looking at the economy right now, where we want it to be, the heart is probably going to be somewhere around agriculture, some industry, and then services like ICT and the creative sector. And what they're trying to do is get or develop those to the point where they can be dollar earning. Because once they are dollar earning, one thing is that you have diversified your FX earnings, but then the parts of the economy that need FX can also get FX, right? So I take you back to, I think, 2015, during the height of the crisis, the petroleum marketers and downstream players needed FX, right? And because they were a priority area, they got FX. And I remember that the CBN linked them up with upstream
operators,
exactly.
Get direct FX
exactly, right?
Yes.
And that meant that for most of 2015 and 2016, there were no challenges in that particular sector.
And we seem to have resolved that.
Exactly, right. But you found that manufacturers, for example, up until, I think, midway 2015, when the CBN imposed the 60-40 rule, they got no priority treatment, and they had no direct access to FX.
Now they've gotten that over the last 1 year. Since April 24, 2017, the central bank has been intervening at least twice a week in both for the wholesale manufacturing, SMEs, then the invisibles, on average $225 million. So do you think that we having a bit of a decent supply of FX from the petrodollar, from the central bank, into this side of the economy, the manufacturing sector that we need to grow, not just for exports, for dollar inflow, but also to make sure that there are jobs on the local market? Do you think this is strong enough?
Yes, I think oil at $75, our output about 2.0 million barrels a day is good and is enough. The issue has never really been the size. The issue has been the vulnerability, right? All it takes is a couple of meetings in Saudi Arabia, shale oil pumping a lot more, Chinese demand falling a lot, and you find that oil has gone to $55 or $50 a barrel, and suddenly your FX is down, right? So the issue is that it's not diversified. The issue is that oil still, or has still accounted for too large a share, and we need, one, to wean ourselves off FX. We need to actually be able to use domestic raw materials, but they have to be of decent quality and cost. And then at the same time, other parts of the economy, like services, like agriculture, need to be able to provide some level of FX support.
I like that. Then that brings us to this. Now, right now, on twice a week, the manufacturing gets some dollar direct for some part of their needs, resources, whatever, raw materials from the central bank. So they got that. But they need the Naira content, isn't it? Yes. So, but the Naira content is where it looks like it's a problem. Because if manufacturers go to the banks, the credit, the exchange, the interest rate now become to be an issue. So why the central bank seems to have resolved one part of it, which is the twice a week allocation to manufacturers, when they go to the banks for the Naira content, which is to pay salaries and buy diesel and a few things, which you're not getting the FX for from the central bank via the I&E window, what happens to that? That is one problem we have not been able to resolve.
Yeah, so agreed. The issue of high lending rates has been a problem. I don't see it as a monetary policy problem.
It is a monetary policy issue?
It is a monetary policy issue in the sense that inflation generally is dealt with by monetary policy, but Nigeria's historically high inflation hasn't always come from the monetary aspects. It hasn't necessarily been a demand or money supply challenge. It's cost. When you break inflation down, what it really means is that the demand in your economy is growing, but supply is constrained and can't meet it. So because of that, prices go up. So the problem really comes from the supply side. The problem is our economic base in terms of infrastructure and so on doesn't allow for supply to function properly. And that's not something that the monetary policy can address.